Forget software margins for a second. We are watching a company build physical memory chips and pull down an astonishing 81% operating margin. Welcome to Earnings Unscripted. It is June 24th, 2026, and we are breaking down fiscal Q3 for Micron Technology, ticker MU. Miro, an 81% margin on actual hardware is just hard to compute.
It really is. Look, they posted $41.46 billion in revenue. That is up, I think, roughly 74% just from the previous quarter, which was $23.86 billion. You do not normally see that kind of sequential velocity in concrete and silicon manufacturing.
No, and the earnings came in at $25.11 a share. That, well, actually, it more than doubled the $12.20 they did in Q2.
By the way, obligatory reminder here that this is all just our personal opinion, definitely not financial advice. But clearly, investors did not need any advice to buy this print. The stock just took off.
Yeah, it traded down about 3% during the day, closing around 10.48. But the minute the release dropped, it spiked over 15% in after-hours trading, crossing 1,200. And keep in mind, that is sitting on top of a 130% gain during the quarter itself. The tape is completely directional right now.
Unbelievable momentum. So what is actually moving the needle this hard? I mean, they make DRAM and NAND storage, which usually behaves like a hyper-cyclical commodity.
Usually, yes, but they have effectively ripped up the old spot market playbook. The core data center unit alone hit $11.52 billion, doubling sequentially. They're basically riding this unprecedented wave where data center demand is entirely restructuring their business model.
Right, into these massive take-or-pay agreements.
Exactly. They're shifting away from short-term handshakes into what are effectively contracted SaaS-style lock-ins. And the end markets are shifting too. We heard CEO Sanjay Mehrotra say it's not just basic server racks anymore. He was pointing out that, well, humanoid robots consume 10 times the memory of a highly advanced self-driving car. So this AI infrastructure build-out is pushing way beyond just smartphones and laptops.
Right. Intelligence requires state, and state requires memory. You can't run complex AI on an empty system. But the actual shocker for me was how they're securing the capacity to build all this. Customers are giving them essentially billions in upfront cash just to hold a place in line.
That's wild. All right, let's get into the details on how this massive internal bank is actually working.
Yeah, that is exactly what it is. It is essentially a massive interest-free loan from their own buyers. Look, normally if you want to build out a fab, you go to the debt markets. But Mark Murphy on the call walked through this staggering $22 billion in upfront financial commitments.
And just to clarify, that is hard cash in hand?
Mostly. It is $18 billion in direct cash deposits and another $4 billion in letters of credit. And the accounting here is actually fascinating. They treat it as financing cash flow, not operating free cash flow. So they hold this cash during the performance phase of the contract, and they only start returning it toward the back half of those multi-year terms.
Okay, so translating that, big tech is essentially paying out of pocket to build Micron's new factories. They're so desperate for AI supply, they're basically acting as venture capitalists for the foundry.
Right. I mean, it completely de-risks Micron's capital expenditure. And they locked 14 of their 16 strategic customer agreements into these multi-year bands stretching all the way through 2030.
That really sounds more like a software business. It feels like we're looking at SaaS metrics, not silicon.
Exactly. That is why they are formally reporting remaining performance obligations, or RPO, under ASC 606. You literally never see that in commodity hardware. Memory used to be a pure spot price game. Now they have a contracted backlog of $100 billion. It completely changes the risk profile.
Wait, 100 billion guaranteed? But surely the prices fluctuate within those bands. If the market floods with memory next year, those margins take a hit, right?
You would think so. But no, the floor prices are hard-coded. Sanjay Mehrotra actually made a massive claim here. He said, and I'm quoting, "Gross margins at the floor will be well beyond the peak that we experienced in the past cycle. Well beyond those."
Wow. I mean, confidence is definitely high. But hold on. what if a major customer just miscalculates their own demand? Say they overordered, the AI hype cools off a bit, and suddenly they're stuck with billions in take-or-pay contracts for chips they do not actually need. Does Micron really sue a giant tech client to enforce that?
That's the $100 billion question. Legally, the customer is on the hook. Practically, enforcing a take-or-pay on your biggest partner destroys that relationship. I think Murphy realizes they're entering uncharted waters here because he specifically noted these cash deposits are unrestricted, but he sounded incredibly cautious about returning any of that capital to shareholders before late 2026.
Right, because they might need a massive cash cushion if the music suddenly stops.
Exactly. Plus, the literal cost to make these chips is going up. Micron explicitly warned that transitioning to complex tech like HBM4 and DDR6 is going to cause their blended cost per bit to rise from current levels.
Sorry, the cost per bit is actually going up. So if costs climb but prices eventually hit those structural floors, the net margins get squeezed anyway.
Right. It's a brilliant strategy today, but they're building a very rigid structural system for themselves a few years down the line.
So the squeeze might be inevitable eventually, which really makes you wonder how sustainable this all is once we look past the immediate euphoria. Let's step back a bit. What does this mean for their actual trajectory heading into next quarter and beyond?
Well, mathematically, they are guiding for a record $50 billion in revenue next quarter. And that assumes an 86% gross margin.
$50 billion in one quarter? Okay. That is, honestly, it is hard to picture for a pure hardware business.
Right, but here's the actual catch. The CFO explicitly warned about a meaningful moderation in the rate of price increases. So the pricing upside is starting to hit a wall.
Slowing down while their costs are climbing, right? Because they said R&D is ballooning next year.
Exactly. I think operating expenses are guided to jump by roughly $1 billion in fiscal 27. It's the cost of technological transitions. Moving to newer generation memory literally drives the physical cost per bit up.
Okay, so that margin squeeze is actively baking into the cake right now. But Mehrotra sounded so incredibly bullish anyway. He explicitly said they expect supply to stay tight beyond calendar 2027. That is years of leverage.
Yes, assuming those massive take-or-pay agreements hold if the macro environment shifts. But it is an incredibly strong position today. They basically turn spot market silicon into a contracted SaaS backlog. I genuinely respect the maneuver.
There it is. You actually admitted they did something well. I need to clip that audio.
I said I respect the maneuver. I did not say I want to blindly pay a premium for the stock.
Fair enough. Well, I guess we'll see if those billions in customer deposits actually protect them when next quarter rolls around. I think that covers the big story for today. Let's send it over for the wrap-up. If you want these earnings breakdowns to just show up in your feed, go ahead and follow the show. And just a quick aside, this podcast is generated with the help of AI to synthesize the raw data. But the market logic we explore is very real. We would love to know what tickers you want us to pull apart next, so drop a note to earningsunscripted@datamadness.ca or find the X link in the show notes. See you next time.
Catch you later.